Thank you for listening to the Financial Lens episode titled End of the Tax Year Strategies. We're getting close to the end of the tax year, and this is the opportunity to take advantage of tax opportunities before you prepare your taxes next year and find out maybe it was too late to take advantage of a planning strategy. One strategy that is available for folks who earn income is to put money into an IRA. The other strategy is to do what we call bunching deductions, where we take deductions that we might do every year and move them or shift them all into one tax year. The reason we do that is because under the current tax law, it's actually very difficult to qualify for itemized deductions. For many filers, the standard deduction is higher than what it would be if people were to itemize. It might be an opportunity to bunch tax deductions in the same year if it allows you to exceed the standard deduction thresholds. Another strategy that is often referred to during this time of the year is tax harvesting. Certain securities are sold that have had a gain, other ones are sold that have had a loss, to balance out the gains and the losses. This, quite frankly, is less of a tax planning strategy as it is a reallocation strategies where we get rid of some portfolio holdings that we don't care for, sell them for a loss, or maybe we don't get much of a gain on them. And if they are a loss, they allow us to perhaps sell off our other securities holdings that maybe have appreciated a lot, and we may want to pull back on that holding without taking a tax hit. Charitable contributions are a big consideration this time of the year, and there are two things I'd like to talk about. One is to donate appreciated assets. When we donate appreciated assets, there are actually two benefits. One is that we get to deduct the market value of that investment, and secondly, we don't pay taxes on the appreciation of that valued investment. The second opportunity we want to look at is something called qualified charitable distributions. A qualified charitable distribution is available to folks who are over 70 and a half, and what it allows you to do, instead of taking a required minimum distribution and perhaps contributing that to a charity, when we take the distribution from an IRA, that will be a taxable event, but the contribution to the charity might not be deductible because we might not have exceeded our standard deduction. So what an option is to take that IRA and do a direct transfer from the IRA to the charity without taking possession. When we do that, that distribution does count toward the required minimum distribution for folks that are over 72, but it is not taxable. So there's a good way to meet our required minimum distribution without having to pay taxes on it, and it's specifically available for folks who are charitable minded. The other thing we want to talk about is doing Roth conversions. Now, Roth conversions are something that are in the news. There are discussions that this might be a planning strategy that will be disallowed in the future, but this is the way it works. If you have an IRA, it is an investment that you never pay taxes on, but you will pay taxes on it when you take distributions. If you have a Roth IRA, it's just the opposite. You did pay taxes on it when you put the money into the investment, but when you take money out, that is not taxable. What some folks are considering, and something that we advise many of our clients to do, is to take an IRA and convert part of it to a Roth IRA. When that is converted, it's a taxable event. However, there are no taxes in the future. Why might we do that? Because we might be paying higher taxes for that IRA distribution in the future. We do know that the tax cuts back in 2017 were temporary tax cuts. And we do know that those tax brackets are expected to increase under the law that was set up when those tax cuts happened in 2026. So what is the point? If we know that the tax brackets are going up and we have money in an IRA, Unlike those years when we were putting money into an IRA and we thought we would be in a lower tax bracket, if we're already retired, we might be deferring our taxes on IRAs to higher tax brackets because they will go up in the future. We also know that folks who have not started to take their Social Security and have not started to take distributions from the IRAs because maybe they don't have to take them out because they're not old enough to be required to take them out, we know that some folks who are in their early retirement years might have actually more income. And that combination of a higher tax bracket and more income is a bad combination. So we sometimes, for clients, especially if they do qualify, if it's a tax advantage to do that, we do a Roth conversion. The other thing about IRAs, when we take distributions from them, they could cause the Social Security benefits that we get to be taxable. Social Security is something we put money into while we're working, and then the thought is when we retire, we can get those distributions. However, the government changed some laws many years ago, or over 10 years ago, that the Social Security benefits are potentially taxable depending on our income. What income counts toward that? Well, our Social Security income. Also will count toward that is pension and IRA distributions. So what could theoretically happen is an IRA can be taxed because we know that IRAs are taxable, but it can also cause Social Security to be taxed. So in a way, it could create double taxation. The last thing we'll talk about looking at tax brackets is to look at assets that have accumulated interest, specifically savings bonds and annuities, non-IRA annuities. Those instruments can have accumulated interest, which will eventually have to be paid, and it might be paid at a higher tax rate. So when we have those instruments in place, we may want to consider cashing out some bonds. We may want to consider taking out some interest from annuities so that this tax liability does not build in these instruments. So there we have it, end of the tax year strategy.